Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking. All right, and we are back for another episode, another session, if you will, of the Real Recipe. Today we're going to talk about, I guess, a little bit of a confusing topic. Self-employed borrowers, people who don't show income in a traditional way, navigating the field when trying to get financing when you don't have traditional income. I mean, it's a pretty broad topic, truthfully, but there's really only a few products that people can fit into when they're self-employed or when they don't have a conventional income stream like pay stubs and W-2s or tax returns, et cetera. So today we're going to talk a little bit about how to get financing in an alternative way for people that may not qualify conventionally.
So is this for people who because there's obviously anyone who's self-employed, used to be like, oh, you need to show 2 years of income or pay stubs or whatever it might
2000.
be. So I said it used to be.
Yeah.
But then also people who are self-employed or maybe they have to show a certain amount of liquid funds. Like, how does that work essentially?
Yeah. So the biggest section of individuals who have a tougher time qualifying are self-employed borrowers, and the reason for that is pretty basic, right? They make $500,000 a year in income,
right?
In gross income, but they literally write off every expense that they have. I do it myself too, and then you're all of a sudden your $500,000 whittles down to $60,000 a year.
It's great until you need a mortgage.
Right. It's great until you need to borrow money or get financing for something, right. And then it becomes a disadvantage for you. And so self-employed borrowers in particular find it very difficult to get financing, especially when they are aggressive with expenses and are writing everything off that they can. Right. So typically in that scenario, you'll find a couple of different ways to qualify for a mortgage. If they have certain expenses can be added back to a self-employed borrower's income to potentially get them to qualify in a more conventional way. Okay. But in most cases, it's not enough to get them. They want to buy $1 million house. Mm-hmm. They can clearly afford $1 million house.
Right. But
they're not going to afford it on a $60,000 a year salary, or income. So there are certain things that we can do on the conventional side of things to add back certain expenses to their income, and maybe that makes the difference for them to qualify. If they can't, we have a couple of options that are available to us. Right. One would be, we could do potentially a bank statement loan, where, we get 12 or 24 months of your bank statements, whether they be personal and or business. And we would look at the amount of deposits that you're putting in. And, there's a calculation that we use, but, based on the deposits that you're depositing on a monthly basis, we'll determine what your monthly income is that we can use. We can also use, let's say you have $1 million in the bank and you're buying $1 million house. We can use, something called an asset depletion loan, where we know you have the money to pay off the loan or pay down the loan. We'll let you borrow a certain amount of money, and you have to hold the money, in a certain account sometimes, and you have to do certain things with it. But, if you have a certain amount of assets, we may be willing to just give you the loan just based on the fact that you have a certain amount of money in the bank.
Now, when you say hold it in a certain account, like you as a lender would want them to open up almost like an escrow account, or
no, it doesn't. It doesn't get some banks require you to have an account somewhere where they know that they know where, not that they can access it, but that they know where the money is.
Okay.
Right. It becomes challenging for people to start moving money around, and some banks recognize that, some don't. So that gets a little bit more off into the weeds. Right. Some lenders want certain things and some lenders want other things. But no, you're not literally taking out $1 million and putting it into an escrow account and then I'm letting you borrow against it. Mm-hmm. That's not how it would work. But you know, the lender just wants to make sure that they have that the money's there.
Right.
That I'm giving you the money based on the idea that you have money. If you take out $1 million, you no longer have the money. You know, that becomes a little bit of a challenge. So you have programs like that. The other thing that has come to the forefront in the last couple of years is something that I was intimately involved with at one of my predecessors. So people are going to cringe when I say this, but stated income has come back. Stated income has come back. There, you know, some of the looser qualification guidelines for self-employed borrowers or borrowers who don't have typical income streams have come back.
So many people just got PTSD.
I know, right? People are like freaking out right now. What do you mean stated income? Well, what we've done is we've whitewashed it. We've gotten away. You know, we no longer say that it's stated income.
Right.
We say, okay, you're self-employed. Give me a 12-month profit and loss statement for your business.
Yeah.
And
it's like 90% of the people don't have it or not.
Well, right. You know, now some guys will go to QuickBooks and they'll print it out on
QuickBooks. Yes.
Yeah, and you know, I mean, you could read between the lines there. If you're self-preparing your P&L, you know, you can
probably got a good handle on.
Yeah, you're probably going to qualify.
Good handle on some finances.
Yeah. You know, you're not throwing depreciation in there, and you're not, you know, throwing certain expenses in there. But you know, at the end of the day, you know, that's an alternative way, you know, people can qualify. You know, at one moment in time, we did have no ratio loans, which means that all I care about is that you have a job, and by you having a job or being self-employed and owning a business and earning income, you know, that was enough. I didn't care about the income that you were making, you know, so long as you were putting down a certain amount of money. You know, and at the end of the day, a lot of these self-employed loans, a lot of these borrowers that don't qualify, whether it be for investment properties or primary residences, as long as you're putting down enough money, you're going to find money. You're going to find somebody who will finance a transaction for you. That's the beauty of lending lately is, you know, if you're putting down 30, 40, 50%.
That was my next question. I mean, I know, you know, residential and commercial a little bit different as far as what you have to put down, but what type of down payment, you know, does that look like really?
Typically, it's going to be at least 20%.
Right. At
least 20%, probably 25%, as credit has starting to tighten a little bit in the environment that we're in. Credit has tightened up a little bit. LTVs are coming down, which means that they want more equity or want more down payment. But I mean, you literally can go. I mean, if you're putting down 50%, I can get you money with no questions asked.
Right.
Like I don't care about your job. I don't care about your income. I don't care about your past. I don't care about where the money's coming from. You put 50% down because it's basically an asset loan, like an asset-based loan. Like, hey, 50%. I've got more than enough equity in that house.
Right.
I don't care about my loan. I mean, not that I don't care about my loan, but you know, if I have to take it back, I know I'm going to be covered because I'm not going to see that kind of depreciation in the value of the property.
This is interesting because I have one transaction I'm involved in. The other one, someone had actually reached out to me on.
Yeah.
One was a $300,000 purchase, and they were putting almost all of it down. They were taking out a $40,000 mortgage.
Which what's the point of doing that?
They got denied. They get denied a $40,000 mortgage.
Why?
I don't know because I don't know the lender. So
that's
I'm
crazy.
just thinking to myself, I mean, you can go and get a private loan on.
You can get a car loan for $40,000. I can get a private
loan in literally probably 10 minutes online through Prosper or something like that, or Lending Club for $40,000.
Right.
So I'm thinking, what?
And you don't have to provide anything.
And you don't have to provide anything.
Yeah.
And I can say this only from personal experience because of you know, having to refinance like a student loan. I mean, I remember like when Prosper and like Lending Club were all coming out, it's like, what's your annual income? And you type it in and they're like, here's $40,000 and they deposit in your bank account the next day.
The next day or 2 days later.
But so I don't know, I mean, something like that. I'm like, how, that's obviously so down payment heavy. How could they not, I mean, maybe they just don't have the resources or know someone to help them get it, but they have to be able to connect with someone for $40,000. I mean,
you have to remember in lending, you get as originators, as loan officers, at least on the residential side, you get stuck in a rut.
Right.
You get stuck being programmed to think, oh, it's Fannie Mae, Freddie Mac, you know, FHA, VA, USDA. These are the programs that I have. And then out on the edge here, you have non-QM stuff and you have some, you know, all this other stuff going on.
Right.
But people are so focused sometimes on this smaller, on this larger pot that they forget about all the stuff on the fringe.
Right. They get a little too rigid.
Yeah, and they don't take the time to learn out on the edge here what alternative products are, and that's where I live and breathe out on the edge here because I love that stuff. You know, even though I do all the conventional loans,
Yeah.
you know, I just the problem with me on the conventional side is for the amount of effort that I have to put into to do a loan, you know, the amount of money that I'm going to make as an originator, the margins have compressed so much now.
Right.
It's not really worth doing that stuff. It's worth it here because the client is more loyal, there's more money to be made, and you're providing a service to somebody.
Right.
You're getting a loan for somebody that wouldn't normally qualify
and if
for
somebody's
something.
coming to the outside here to get this type of loan, like they're expecting to pay a bit of a higher interest rate too,
Yeah.
because they
Yeah.
know that they can't fit into that conventional model. The other scenario that someone reached out to me about the other day is they have a client who's buying, I think it's like a 1.135,
Yeah.
and they're putting 600 and change down, and they have to get a mortgage for like 435 or something, and
Yep.
they got denied because they have they're very asset heavy, and they're obviously putting a very nice down payment down, more, you know, but lender had advised that they took into account finally their alimony payments, and that threw off their debt to income ratio. So
that right there. I don't know the lender. I don't know who. Obviously,
Right.
I don't know this transaction. Other than to just say that is the originator's fault, and the reason why that's the originator's fault is because the originator didn't take the time to ask the client
ahead of time,
and
and
or didn't use the appropriate application process to vet that out
Right.
earlier on. Like we use an electronic application, and very specifically, one of the questions is, are you divorced? Do you currently have to pay or receive alimony, child support? And if you check yes, it automatically starts to ask you questions. Now, if the client says no, that's on them.
That's one thing,
But
I was surprised by that because even I know that that's something that's definitely going to be taken into consideration. I think that the agent was definitely upset because she had spoken to 2 loan officers or 2 originators, and they got pretty far in the process, and now they need to close ASAP, and they don't, where are they going to go for a mortgage, right? So Ryan's like, let's hang up, let's stop the podcast.
Let's do a call live on the phone,
But I know that it's frustrating for someone who's so liquid asset heavy that they can't get.
Yeah.
Well,
and see, from my point of view, whether you're self-employed, whether you have non-traditional income, or alternative types of income, as long as you're putting down money, there is a home for you.
Yeah.
It may not be what you want. It may not. The interest rate may not.
Can't be choosers. Sometimes.
Yeah, you have to and that is a delicate conversation sometimes with clients. Like I had one the other day, and I told him, I was like, listen, we could try you with your tax returns. I know your situation.
Yeah.
I don't think you qualify, but hey, we'll go down the path. I'll gladly walk with you. But just know that if it's not, this is what it's going to look like. Mm-hmm. And it has either an 8 or a 9 in front of it from an interest rate standpoint right now. And as painful as that may be, you have to do what you got to do to buy the house, you know, and suck it up. Now, he makes a lot of money, so he was more upset that he has to pay that kind of rate because he doesn't qualify. But at the end of the day, if you're putting down enough money, the odds are there's financing options available. And the challenge, like I was alluding to before, is when you're an originator and all you know is Fannie Mae, Freddie Mac, VA, USDA, all these more better known programs. You don't know what's going on the outside. You don't think to go, oh, hey, I can go here with that loan, or I can go there with that loan, and then. Not only is it knowing where to go, but it's also the silly little nuances to it. Like, oh, hey, you have to have 3 trade lines on your credit, or you have to have If you're going to do bank statements, you have to take 50% of the deposits, and that's the income that you're going to use to qualify. You know, all these little nuanced things for each lender, because each lender has differences too. So, but as you put more money down, the odds are that you're going to find somebody out there that'll do it and get the financing for it. You know, but there are different programs that are available out there. You know, like I said before, even just stated income. If you've got really good credit, I mean, you know, you can provide a P&L. You know, now a lot of lenders have shifted to wanting the accountant to do the P&L.
Okay.
Which I personally have some challenges with, because now you're putting the accountant on the hook for the income that you're using to qualify.
Right.
And if you pay attention to the news, one of the things that our former President Trump is being indicted on is, or they're going after him for, was lying on applications, you know, for financing. It's the reality of somebody actually going after somebody for something like that is I don't, you know, this is the only time I've ever heard of somebody actually going after somebody for it. Now it's
like, you don't think that's going to happen.
Yeah,
it's a pizza shop.
Now here's a situation where it's politically motivated, in my opinion, and there's other aspects to that. But the reality is somebody's going to come back to you and say, "Oh, you put $20,000 a month in income on there, but it wasn't $20,000; it was only $10,000." You know, the reality of somebody actually digging into that and actually doing that is
I would find that some accountants probably would not actually want to be on the hook for something like that.
Most of them don't. Yeah. Most of them don't. The majority of them don't, actually. Yeah. It's very rare that you'll find one that'll do it. And if they do it, they want to be paid for it,
right.
And they want to validate certain things with your income. They want to make sure that if they're going to give you an income, they want to
see the proof.
Yeah, they want to know, like, hey, what do you got going on here? And I'll draft something for you, but it's, you know, I'm going to use, you know, supporting data to do that for you.
No, of course.
So, you know, so it's an interesting topic, just because there's so many different ways to do it. And if you just call up Chase and go, hey, I'm self-employed, I need to borrow some money to buy a house.
Yeah.
That's not your guy, truthfully. They're not going to have options. And even some of the bigger firms out there, like your guaranteed rates, or, you know, your cross countries, or, you know, some of these bigger firms, even those originators, they're still the same thing. They don't do it enough to know where to go with it and who to do it with, and then do it well. And that's why you hear some of these stories that you're pointing out, and I get those phone calls too, which is, hey, Rye, we went with XYZ company, they effed it up, and, you know, it's, you know, here I am. Melissa loves to tell me the story, who we had on a couple weeks ago, right? She loves to tell the story because she called me up panicking. She had a $1.8 million purchase, or $2 million purchase. They went to a lender. They thought that they could qualify. Turns out they couldn't, and they were in contract. And they had put up like a $500,000 deposit, and it was a really bad situation, and they had to close in like 3 weeks. And she calls me up and she gives me the whole story, and I'm like, yeah, I got you, no problem. Closed it in 3 weeks, no problem. It was a pain in the ass, a lot of paperwork, but we got it done, and we were able to close. You know, and it's just knowing the product to use, the lender to go to, you know, and what's needed to get it done.
Right.
You know, that, you know, is, you know, we say it all the time, but who you work with matters. It really does, because, you know, you find the right people behind you that you know, can support you and get a deal done, whether you're a realtor, whether you're buying a house. You know, it's important.
Even if you're a realtor and you're doing just regular residential, even if you're not doing commercial at all, the reality is a lot of people who are purchasing as homeowners are self-employed or have small businesses. So you have to go outside of that regular, just standard W-2 residential lending box a little bit. And the problem is some of the lenders either don't, you know, if it's not commercial, it's one thing, they don't lend money. A lot of brokers don't lend money in an LLC for you know, if they just do residential, but they might not have, like you say, the knowledge of those little nuances where, you know, we can make it fit in that box. It just takes a little bit of maneuvering. Yeah.
And the other thing too, is to you really have to take time to sit with the client and explain to them, look, I know that you're going to hate this. I'm fully aware of that. I'm going to have to charge you for it. This is not the loan you want. I get it. but you have to make
But
a decision.
You can be getting the loan.
Right. I can get you the money. Whether or not you want to pay for it,
Right.
you know, is a different conversation. So, you know, the other challenge that we have, and it kind of goes back to the other conversation about, you know, the originators. You know, when you have originators that haven't been in the business very long, which is what we have, you know, or they haven't done their body of work isn't big enough to be able to navigate these different types of products.
Right.
You know, you get stuck in a situation where you think you're working with a great person. I literally had this happen. An agent called me. Yesterday. This is it's because it fits perfectly with this, right? But this is what goes on, and if you're a realtor, this is stuff you got to know. He calls me up and he goes, "Hey, Ryan, listen." He goes, "I got this pre-approval. It's the best offer I got on my listing. It's a pre-approval. I've never heard of the company, and I've never heard of the loan officer." I'm like, "All right, who is it?" So he gives it to me. I'm like, "Oh, I said I've heard of the company. They're not bad. I don't think there's any issues there. Let me give me the loan officer." So I look up her. So I have a database that I can tap into and look at her up, her NMLS. She was in the business for a year, been in the for a little over a year, and I see her production, so I can also get the access to that.
Right.
And I'm like, hey, listen, I'm like, not for nothing. She's been in the business a year, and she's not done any loans, and she's wanting to do a bank statement loan for a borrower, and I'm like, I'm not saying that she's doesn't know what she's doing and that they're not qualified, but the odds are pretty high that she doesn't know what she's doing and that it's not qualified correctly. And then he's like, well, listen, he's like, can I send you the bank statement? I was like, just don't send it an email. Just text me, just text me like a screenshot of it. And he does. And I was like, there's no way that they would qualify for the loan. I mean, even with the deposit that you're showing, and that was only a small snippet. It wasn't like a 12-month or 24-month history. I go, but the snippet that you're showing me, if this is what their average monthly income is, they're not going to qualify for the loan because it's going to be, you know, more than half of what their income is.
Yeah.
So great example of, you know, you got to know these products. They're great products, and there are products out there. So if you're self-employed, you have alternative income, you've got, you know, weird money coming in, you know, cash, all kinds of different things. There are loans out there for you. You can get qualified, but you got to work with the right person. Because if you're working with somebody who's been in the business a year or two and doesn't do these loans often, you're going to get stuck because you're not going to get qualified correctly. And then all of a sudden you're going to go into contract. You're going to get stuck in the deal. You're potentially going to lose a deposit, and it's just going to be a disaster for you. And then you're going to come to me, somebody like me, and you're going to have your guard up, and you're going to be like, "Oh my God, I don't know. I don't know if I want to do this."
Well, because then it's going to be expensive too.
Yeah,
So.
and then I'm going to tell you that it's, hey, by the way, the rate's 8 or 9%.
Yeah.
You know, and so what wound up happening with the agent, and he's like, "Listen," he's like, "I love you. I appreciate that so much that you did this for me." He goes, "You know what?" He goes, I'm taking the lower offer." He goes, "I'm not going with them," even though it was less money down. It was only that offer was 20% down.
Right.
And it was the highest, you know, offer that they got. He's going to go with an offer that was $5,000 less, but 10% down because it was conventional, and he knew the company, and he knew the realtor.
Right.
So there's a great example of, you know, some of these products are not great products if you don't know what you're doing, or can get messed up very quickly if you don't know what you're doing.
Yeah.
You know, and so working with the right people is important. You know, make sure it gets qualified correctly. Make sure you're working with a reputable firm that knows what they're doing. Check on your loan officer. Make sure your loan officer's been in the business for more than 5 minutes.
Right.
You know, for somebody who's been in the business for a year, you know, it's tough.
I guess, I mean, before we close, one thing I am seeing in some of the realtors I work with do this, that when they send their offer in, it's obviously nicely outlined with all the terms, but they include me and their attorney and their loan officer, not just information in the email, but also include us in the email as well. So I'm seeing when they submit the offer, and they're putting a disclaimer in there, like, you know, we've worked with, this is the team I work with. Feel free to reach out to them anytime. And they know that they're qualified. They've been in the business long enough for that they understand what they're doing, and they encourage the listing agent to please reach out to them so they get some comfort in knowing that, you know, their offer is solid and it's not someone who's never really takes a bank statement loan or, you know, like a self-employed borrower doesn't really work with them often. They don't really know what they're doing.
Yeah, and I do that, regularly. In fact, I've actually started to reach out to the other side, and just, hey, listen, some agents will call back, some won't. Some,
Right.
And the ones that do call back are like, oh, hey, I really appreciate that you called me, and I'm like, look, I mean, it's a good deal. It's, borrower's good, they got good credit, kind of walk through the summary of the deal.
Right.
And they certainly appreciate that. So, but being self-employed or having alternative income, I think for some people is scary. They think, oh, I can't get financing, or they've gone down the road and they know that they can't get financing, or that it's difficult to get financing, and I think that prevents them from doing, from entertaining, buying a home or
Sure.
or start looking. If you work with the right lender and you're working with somebody who has your interests at heart, the interest rate may not be what you want.
Right.
It's not going to be competitive, but you're going to get the house that you want, and you're going to be able to move in. You just know that you have to put down money. You're not going to. It's not like you're going to get an FHA loan at 3.5%, or 5% down or 10% down, and that's not going to work if you've got alternative income and it's tougher to qualify you. You're going to have to put down 20, 25, 30% in order to do it.
Yeah. It might not be pretty, but
it might not
we
be
can get it
pretty.
done. Yeah.
You might not like it, but but it's just that's a life decision, right? For you to make. Not only is it a financial one, but it's a life one, right? Like this couple I was talking to you about before. Well, they're in Brooklyn. They're moving to East Hanover. This is where their business is. This is where, they want to raise East Hanover. The Hanover school system is awesome. They're very highly ranked, so they want to get their kids in school here. They want to get them out of New York, and so it makes sense for them from a life perspective. Financially, he wasn't thrilled, but
Right.
it is what it is. But there are different programs out there, whether it be bank statements, whether it be providing profit and loss statements for your business, whether you provide just bank just profit and loss statements, or even no ratios. Those are few and far between, but they're out there. And then on the investment side of things, you don't need tax returns and pay stubs necessary to buy investment properties anymore. As long as the rental income on the property
It's sufficient.
is sufficient, it qualifies. I see everybody throwing out these DSCR loans, debt service coverage ratio, which is all you're doing is just using the rental income on the property to qualify. I mean, I do so many of those, it cracks me up. Like, people are I see originators look at these loans. They sometimes it's like they have like a little glitch in their head. Like, what do you mean I don't need anything? I don't need any income, or I don't need any of this or that to qualify. So it kind of throws them off a little bit. But the other thing too is that a lot of lenders, same thing. They don't know what's out there. So I can get a rate that's just as competitive as a Fannie Mae or Freddie Mac loan on an investment property, and I don't need tax returns. I don't need pay stubs.
Right.
I don't need W-2s. I don't need any of that stuff to qualify.
That's literally the worst part of applying for a loan, anyways. Providing all that stuff,
it's
because you feel like
brutal.
you're going through tax time all over again.
Yeah, it's brutal.
horrible.
Nobody wants to do it, and I get it. It's painful, and that's the other thing too. That's why my business has started to grow a little bit on the commercial side, because the stuff that we ask for on residential loans, whether it be primary residences or investment properties, the stuff that we ask for and the minutia that we get stuck in. Like, I just had it on the call on the ride here. I just had it where a lender was questioning the co-borrower's credit history because he didn't have a ton of credit history, but he's putting down 20%. I'm not using his income to qualify, and they're questioning it. And I'm like,
Yeah.
this is your perfect loan. 20% down, 35 DTI, 781 credit score. Why are we questioning this? This is a good loan.
Give this man his money.
Right.
Yeah.
Right. Pay the man his money. Right. It's just funny. Like that, on the residential side, you get stuck, you get mired in that minutia.
Yeah.
On the commercial side, I feel like they've done it, even though it is more old school and it's different lender to lender. It's a completely different conversation, and that's another podcast that we should do, because lender to lender, it's different. But it's easier to qualify, believe it or not. So there's if you're self-employed or if you have alternative income, there's stuff out there for you. You're just gonna have to put money down, and you're gonna have to pay a higher interest rate. But it is what it is. You just got to deal with it. But also working with the right person is gonna matter. So if you're thinking that you're gonna walk into your Chase branch or your TD Bank or Bank of America, and that
Yeah.
individual is going to be able
That's
to
not
sit
gonna
here
happen.
and help you qualify for that loan. That's not going to happen, and that's where you should be careful of. And that's where most people start, though.
Mm-hmm.
You think, oh, I got my Chase account there. I want to go get
Yeah, or
pre-approved for a
check my
mortgage.
business accounts here
Yeah,
and everything.
yeah, exactly. And even local banks,
Mm-hmm.
even when you walk into local banks, they're asking you for the same things. They don't have alternative products. They don't know
Right.
about all this alternative stuff, nor should they, because their business is banking and not necessarily lending money to certain subsects of the population and qualifying you with alternative methods. They're very, very traditional
Yeah.
too. So, there's a lot of options out there. You just got to ask the questions. Just, do your research. I know telling people to navigate the internet and looking for information is always a dicey conversation. But, you can do your research online. You can find out about some of these products. Certainly call lenders and ask around, and be specific when you ask. Ask, hey, do you can you do self-employed borrowers? Are you able to help self-employed borrowers or borrowers with alternative income? And listen to what you say. You know this. You can get the vibe from
Yeah,
somebody pretty
definitely.
quickly about whether they're bullshitting you or whether they kind of know what they're doing.
Yes.
Right.
100%.
And if the one thing is, if it sounds too good to be true, usually is, especially with lending that kind of money too. So if you think you're going to get a phenomenal interest rate on
Right.
on some
You're
alternative,
being punked. It's,
yeah, there's that's an old school one there too. Oh my god, that's
all
funny.
right, let's go before I start dating myself even more.
Oh my god. All right, so next one we got to do the commercial stuff for
All
sure.
right,
That's another conversation.
Next time.
Yes.
All right.
All right, we'll see you.